You know, for millions of people filing taxes here in the US, the tax code operates with a completely hidden set of rules. We're talking about folks who use an ITIN, that's an individual taxpayer identification number. Today, we're going to unlock the crucial and honestly non-obvious details that shape their financial reality, starting with one of the absolute biggest, the standard deduction. It's a really fundamental question, right? It gets right to the heart of what we're talking about. The entire US tax system is built around these identification numbers. But what happens when you have a legal requirement to file, but you're just not eligible for an SSN? Well, the answer is a parallel system, one built on a different ID, with its own unique and often really complex logic. And that system is built on the Individual Taxpayer Identification Number, or ITIN. The IRS created it back in 1996 for one single purpose: to give people a way to comply with US tax law. It is purely a tool for tax administration. That's it. It's completely separate from immigration status. Now, this is probably the most critical distinction we need to make right from the jump. An ITIN is not an SSN. It doesn't give you work authorization, it doesn't make you eligible for Social Security benefits, and it has zero impact on a person's immigration proceedings. It is exclusively a number for processing federal taxes. So here's our roadmap for this. First, we'll talk about the purpose of the ITIN. Then, we're going to dive deep into that specific rule about the standard deduction. From there, we'll look at the totally different world of tax credits, explore the administrative headaches filers face, and finally, we'll tie it all together to the financial bottom line. All right, let's kick things off with the other tax ID. Really understanding its exact function and clearing up those common misconceptions is the foundation for everything else we're going to talk about. Okay, let's move to the real core of our analysis, the standard deduction rule. This is a perfect example of how the tax code sets up a default path for ITIN filers. But, and this is a big but, it also has a significant and often overlooked exception. And here is that default rule, laid out plain as day in IRS Publication 501. For most non-resident aliens, and that's a tax classification, not an immigration one, the standard deduction is zero, a big fat zero. The impact of this is enormous. It means every single dollar of their adjusted gross income is subject to tax, unless they can itemize deductions. This table right here shows the situation so clearly. For tax purposes, being classified as a non-resident or a dual status alien puts you squarely in a category that is explicitly barred from taking the standard deduction. This isn't an accident. It's a deliberate and fundamental rule baked into the tax code's design for these filers. So this leads to the most important question. Is this a dead end? Is the standard deduction just completely off the table for every single non-resident alien who could really benefit from it? The answer, and this might surprise you, is no. And here it is. This is the game-changing exception. A non-resident alien filer can get access to the full standard deduction, but only if these three specific things are true. You have to be married to a US citizen or resident. You both have to make a formal choice to be treated as a US resident for the whole tax year, and you have to file a joint return. It's a high bar for sure, but it can literally unlock thousands of dollars in deductions. All right, so we've covered how taxable income gets calculated. Let's turn to tax credits. Now, credits are even more powerful than deductions because they chop down your final tax bill dollar for dollar. But for ITIN filers, the whole landscape of available credits is completely different. The first and biggest rule here is an absolute one. The Earned Income Tax Credit, which is one of the largest federal anti-poverty programs in the entire country, is completely unavailable to anyone filing with an ITIN. The law is crystal clear on this, creating a huge financial divide. The story of the child tax credit is more like a legislative roller coaster. Before 2018, a child with an ITIN could qualify their parents for the credit. Then the Tax Cuts and Jobs Act changed that, temporarily requiring kids to have a Social Security number. The crucial point here is that this restriction isn't permanent. The law is currently scheduled to flip back to the old rules after 2025, which makes that year a really critical date to watch. So beyond the tax code itself, there are the real-world practical challenges of just getting and keeping an ITIN. And these aren't just little paperwork issues. These administrative hurdles carry very real financial consequences. And this chart right here shows one of the biggest hurdles. The data shows that applicants who try to go it alone face more than double the rejection rate compared to those who use a certifying acceptance agent, or a CAA. These are basically professionals the IRS authorizes to verify identity documents for them, which just dramatically improves the odds of getting it right on the first try. This adds a really sobering human element to that risk. See, to apply without a CAA, you often have to mail in original, sometimes totally irreplaceable documents like passports, and there's a real chance that you won't get them back. In 2023 alone, the IRS destroyed thousands of documents it just couldn't return. This fact right here underscores exactly why a CAA who can certify copies for you is so critical. And finally, there's just keeping the thing active. An ITIN isn't permanent if it goes unused. The rule is simple: use it or lose it. If an ITIN isn't put on a tax return for 3 straight years, it expires. This can cause all sorts of problems, like rejected returns and lost credits down the line. So let's bring all of this together. What does this whole complex system of rules, exceptions, and hurdles actually mean in the real world? This section is all about the economic impact and your concrete action plan. Take a look at this number, $6.5 billion. That's the amount of Social Security and Medicare taxes paid in just 1 year, 2022, by people filing with an ITIN. It's a stark reminder of the economic machine at work. While ITIN filers are ineligible for Social Security benefits themselves, they are major contributors to the system, to the tune of billions every single year. So, what are the key takeaways here? First, figuring out your tax residency status is everything. It dictates all the default rules. Second, if you're married to a US citizen or resident, you absolutely have to analyze that filed jointly election. Third, to cut down on the risk and headache, using a certifying acceptance agent is a really smart move. And finally, keep an eye on the calendar for those temporary laws, like the child tax credit rule that's set to expire after 2025. Which leaves us with a final thought. The ITIN system is successful, right? It brings millions of people into the tax system and collects billions in revenue. But it operates through this maze of complex rules, administrative risks, and laws that are only temporary. So the question becomes, is this really a sustainable framework for the future? Well, that's a question for policymakers, and now for you to think about.